Life insurance is a crucial component of financial planning, and for many federal employees, FEGLI is often the go-to option due to its easy enrollment and initial affordability. But is there a point when keeping parts of FEGLI is no longer in your best interest? This video is the second of a two-part series where we're taking a closer look at some of the pros and cons of FEGLI. In the first video, we highlighted a few free perks of FEGLI. And in this video, we'll cover some of the drawbacks of FEGLI and when it might make sense to drop it or explore other options. But before we dig into the details, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. Let me start by saying there's no perfect type of life insurance. That's one of the reasons why there's different types of life insurance, such as term life, whole life, and universal life. Each one has its individual pros and cons. The Federal Employees Group Life Insurance Program, also known as FEGLI, is no different. There are various pros and cons of the FEGLI program as a whole, and each coverage option has specific advantages and disadvantages too. For instance, basic life coverage is a solid foundational piece that provides relatively cost-effective coverage along with a few extra benefits at no cost to you. But basic life often does not provide enough coverage for federal employees since it's primarily limited to your salary. As a result, many federal employees also enroll in option B. This option is also called additional coverage because it allows you to increase your coverage by 1 to 5 times your annual salary. So as an example, if your annual salary is $109,400, your option B coverage will be rounded up to the nearest thousand, which is $110,000. However, option B does not get the extra $2,000 increase like the basic life coverage. In this case, a multiple of 1 will give you an additional $110,000. A multiple of 3 will add $330,000. And the highest multiple of 5 will give you an extra $550,000 of insurance. This extra coverage is helpful and perhaps necessary for many federal employees who are looking to provide income replacement and financial protection for their families. But one of the main drawbacks of this coverage is its escalating costs as you age. Option B becomes increasingly more expensive the older you get because the premium rate increases every 5 years. This chart shows how the premium rate changes in the different 5-year age bands, starting at age 45 and going to age 80 and over. Specifically, I want to illustrate how the premium cost for $500,000 of insurance changes based on one's age. At 45, the monthly rate is $65. It jumps to $108.50 at age 50, and then it goes to $195 at age 55. Starting at age 60 and beyond, the premium price either becomes unaffordable or it's just not worth it for many federal employees and retirees. And then in the last column, you can also see the percent change in the premium price for each age band. Given this information alone, many federal employees wonder when is the best time to drop FEGLI insurance. When most people discuss dropping FEGLI, they are mostly referring to option B, although there could be other reasons to drop option A, option C, or even basic life insurance. But in terms of dropping option B, it occurs most often between the ages of 40 and 55, but it surely can occur before or after that age span too. So I want to offer 4 ideal times when to drop option B. First, you may want to drop option B when you can identify a cheaper replacement. If you're under 45, the annual cost for option B is often similar to or even cheaper than the cost for term life insurance in the private sector. But when comparing premium costs, you should consider the cost beyond just 1 year or even 5 years for that matter. Although there may be some short-term savings with FEGLI, it's better to evaluate the lifetime cost of FEGLI versus other options. For example, let's assume a 40-year-old male has a monthly premium payment of $50 for a 25-year term insurance policy of $500,000. Every year, this person will pay $600 in the premium fees, and over the 25-year term, he will pay a total of $15,000 if the policy goes unused. Now, let's consider the cost that this same person will pay with FEGLI Option B coverage. In the first 5 years, this person's premium cost would be lower with Option B. But for the next 20 years, his premium payments will be higher than the alternative option. In total, this person will pay $50,000 in premium fees if the policy goes unused, which is $35,000 more than the other option. Keep in mind that private insurance also gets more expensive as you age, but the key difference is that the cost for most private policies stay level once you purchase it. Secondly, you may consider dropping Option B coverage if you want additional product features. Option B is a group term policy that doesn't provide any features beyond a lump sum payment to your beneficiaries. But if you want life insurance that provides permanent coverage or has cash value growth, then another option may be better for you. Some other common features or riders that people may seek out are long-term care, critical illness, disability, or accidental death. A third reason to drop your Option B coverage is a change in your family structure. As I stated earlier, most people need life insurance to replace income or provide financial security for loved ones in case of premature death. But if you get divorced, if your spouse passes away, or if you have independent adult children, the need for life insurance may not be as strong as when you have a living spouse or underage dependents. The last reason to drop your Option B coverage is a change in your financial situation. This often occurs as you age and gain sizable assets. If you accumulated significant savings in your investment accounts, or if you have your mortgage and your debts fully paid off, then life insurance may not be needed for financial protection. In any of these cases, you can cancel your Option B coverage at any time through your agency's electronic enrollment process or by submitting Form SF-2817 to your Human Resources Office. Even though we have focused on when to drop FEGLI, you may want to keep or lower your coverage amount if you have a pre-existing medical condition and you cannot qualify for life insurance in the private marketplace. In summary, many federal employees often stick with FEGLI due to convenience, but you should periodically evaluate whether your existing Option B coverage still makes sense for you. Rising premium costs, as well as changing financial and personal needs, may cause it to be less beneficial over time. When exploring your other options, it's important to compare costs, coverage, and features. And if you're looking to replace your coverage, make sure you have new coverage in place before canceling your FEGLI to avoid any gaps in your life insurance protection. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com, or you can schedule a free consultation by clicking on the meeting link in the video description. Thank you for watching, and we'll see you on the next Money Briefing.